Hello, I'm David Russell, VP of Content Strategy at TradeStation in Chicago. I'm a specialist in the U.S. stock market with over 20 years of experience covering it as a journalist and analyst, and I'm here to help you trade it more effectively, no matter where you might be. It is Tuesday morning for you down in Australia, but it's Monday evening for me in the United States. I'm coming from Chicago from, as Daniel said, TradeStation. We are a sister company of Monex Australia, and it's great to be with everyone. So first I wanted to just mention a few important disclosures. The following presentation is for educational purposes only. All symbols and trading ideas discussed by the instructors are for demonstration purposes only and are not recommendations. The presentation does not offer solicitation of any kind in any jurisdiction where any TradeStation affiliate is not authorized to do business, including to, but not limited to, Hong Kong and Japan. Active trading is not suitable for everyone. Options trading carries a high degree of risk and is not suitable for all traders. Please read the disclosure information in the PDF available, handout that's available. Actually, I don't have it on this, but there's basic information that's available if you require it. Okay, so let's actually start taking a look at some of the things that are happening now. It's a big day in the United States here on Mondays. A lot of you guys probably know. First, I want to tell everyone that everything we're going to talk about in this presentation is available on the Monex Australia website. So if you go to monexsecurities.com.au and then you go here to Insights, you'll actually see that there's a blog, and we actually have essentially a summary of this webinar available right here so you can follow along. I always like things like this. I know you guys are busy. It's the beginning of a workday for you over there. No need to kill yourself taking notes or anything. We have all this information available. All right, so if you look at right now the overall state of the S&P 500, looking at the United States, first I want to very briefly start off by looking at the American markets using the TradeStation platform. It has a few indicators on it that are kind of interesting, so I just want to very quickly look at this. Excuse me. Now, if you look at the S&P right now, this is the overall S&P 500. There is a level from back here, basically the end of September of last year, that we're just kind of pushing against and chopping against. We've had a big rally here, as most people know, ever since, basically the end of last year. It started the day after Christmas, and it's just continued higher. So here we are now pushing the top of this range, and I think it's important to take a step back and look at a few things. So I want to start off with an overview of the S&P 500 right now. There are some things right now, I think that, and by no means am I bearish on the S&P 500, but I also think it's important to realize that now we're at a spot where it could make sense just to kind of wait. The market will go through periods when there's a strong trend in a certain direction, and then after that trend kind of passes, you're going to see a period of sideways. And when you look at what a period of sideways really is, it's not just sideways, it's chopping up and down. And when you have chopping up and down, it makes sense to be waiting for the down in terms of getting long, in terms of buying. And when you look at the S&P right now, there are some real levels, especially this kind of peak from March 21st, right around 2850. That to me is interesting. The 50-day moving average is the red line here. It's a number a lot of other people look at. So for me right now, when you look at this old resistance level, when you look at what's happening with the situation with China, right now, in my view, it makes sense from a point of view of the overall index, the overall market, it makes sense to be kind of taking a step back. We're up, I think, 5 of the last 6 weeks. It's been a very strong move. And now if we go into more of a period of kind of neutrality, kind of drifting, that's going to be the opportunity to be looking for better entries. Now, it does not mean that the S&P is bearish. And I think right now, some of the things I want to talk about are areas that do have some potential regardless of the overall market. But I think when you look at right now, the overall situation that we see, one of the things that stands out, and I'm going to jump over here now to the Monex Australia platform. This is a watch list I created. If we go here to my, my watch lists, I have one here called these are the SPDR Spider Funds. So just to very quickly show, this gives you a really quick view of the market overall. And when you look, these are all the main sectors, things like materials, but financials, energy. These are the major sectors in the United States. When you look at where these guys rank in terms of their overall performance of the 52-week high, we see energy is kind of near the bottom of its range. We also see, for example, healthcare is near the bottom of the range. But in particular, energy and materials, these are things that are more affiliated with the kind of global economy. So when you look at this right now, very often we start to see weakness in energy, that is something that will at least hold back the S&P 500, for various reasons. So I think right now we're starting to obviously see some weakness in energy. Now, some other things we have is that when you look at the overall market where we are right now, we entered 2019 with a lot of bearishness, a lot of people extremely underinvested in the American stock market, and we came exploding back higher. But that was 4 months ago. We've had 4 months of steady gains. We also have now some incredibly strong economic news in the United States. Our first quarter GDP beat estimates. We had a lot of payroll employment numbers last week that beat estimates. There's a lot of evidence that the American economy is doing the best now that it's done, at least since the 1980s. We are seeing growth in the United States without a lot of debt. We are seeing job creation. We are seeing reinvestment in factories. We are seeing things that most of us, myself as an American, we've not seen this sort of thing in generations. It's a new kind of economy for the United States, and it's quite bullish for the United States. It's really a great time to be considering the American stock market, because right now, when you look at other global, other places in the global economy, unlike 10 to 15 years ago, right now it's easy. Well, it appears that the case favors the American situation. So it's a great time to be looking at United States equities. But at the same time, in the near term, a lot of good news has been priced in, and we are in the middle of earnings season, but the big bulk of earnings, we're just going past them. We're going to that second half of earnings season. And the question now is, when you look, all these big economic numbers like monthly payrolls, GDP, all this stuff is now in the rearview mirror. So now when you look at it, the opportunity for new catalysts to come in, new kinds of news, is now more likely we're going to get things that are potentially less bullish because we've had so much positive stuff happen so far. So my honest feeling is that people are a little bit too confident and complacent that they think Trump is just bluffing on China here. So then we just need to be careful. There's always been the assumption that when Trump cracks the whip in terms of the tariff and trade tactics with China, then he's just going to back down. But right now, he's got a great economy to work with. His approval ratings have been rising in the United States. And quite honestly, most other American politicians, if you really look, they do not oppose what he's doing with China. The Democrats are even agreeing with him on some of the stuff with China. So there's not a lot of reason right now for Trump to back down on this China thing. A lot of people in the market are just saying, oh, it'll go away. It's just a tactic. I'm not a political scientist. I'm not going to predict anything, but I'm not so confident that that's going to be the case. Doesn't mean to be overly bearish about everything, but it does mean to be careful of those things that could be impacted. So I think right now, when you look at that, the main concern I would have, aside from the global equities, is going to be semiconductors. The American semiconductors have done really well here. And now we're in a situation where a lot of optimism has been priced in toward companies like NVIDIA, Advanced Micro Devices, a lot of these chip companies. There's been a lot of confidence that the chip sector is going to come back. It had a horrible end to last year, and the numbers are starting to turn, but at the same time, we've seen a huge rebound. I want to show you the Philadelphia Semiconductor Index. This has had a big rally. I'm sorry, I'm showing the wrong thing here. SOX. Wait a second. SOX on TradeStation. And then you can see this has rallied back very strongly. So I just want to point this out because semiconductors are important to the NASDAQ. It's important to technology stocks. It's important to growth stocks. A lot of these high-flying companies everyone knows in the NASDAQ and things like that. We just have to be careful, I think, right now, because if we have trouble with China, it's going to likely hit the semiconductor space, which is priced in a lot of good news. And if that news turns out to be negative, that's something to be careful of. But there are other things to look at. So right now when we look, one of the things I want to highlight, overall growth is strong. When you look at the market, if you look at the sectors that have been doing well, if we go back here to the Monex platform, what we can see is these are risk-on sectors. These are sectors that do well in a strong economy. For the most part, things like financials are near their highs, industrial stocks. If we were looking at a recession, that would not be true. These bars would be way over to the left, but they're not. So this right here is telling us that the things that are more, geared toward a strong economy, those are outperforming, and that's where the optimism is. So we definitely have right now the sector performance of the S&P 500 is telling us that people are bullish. so at the same time, I think it's important just to realize that when you look at the economic numbers, there is a lot of strong and positive things where people are looking to take risk. I just want to point out that the issue with semiconductors is they have that China risk. But we do see other parts of the market, media companies and software companies. There is a huge cycle of investment right now in the United States in cloud computing and in software. And there's companies that are moving just gazillions of gigabytes of data from enterprise to the cloud. They are moving these, they're doing data mining. There's all kinds of stuff happening when you look at cloud computing. There's a huge surge of stocks that do online and cybersecurity, all kinds of things involving data, security, cloud computing, companies migrating their businesses to data centers. This is a huge growth area. Right now, there's no names I want to talk about in that space, but it's important to realize that we are in a cycle. It doesn't get the most attention, but this is a big transition. This is like when people went from using, old-fashioned mail to using, internet, when they went from using, newspapers to online or whatever. This is a big change. It's going to last years, and there's going to be all kinds of opportunities in it. So we want to be thinking about that and looking for those opportunities, and we're going to get to those in a future webinar. But one of the other things I think that's most interesting is then you turn to the real economy, the things that are not technology, the kind of old-fashioned things. Banks, housing, and transportation stocks have all been doing well. It's very interesting when you look at housing. I was looking for some opportunities in housing, and right now they've all run very nicely. But the American housing market is coming back. It has been a long time without a lot of construction. In fact, one of the stories here, if you look on the Monex website, they took one of the stories that I had written recently, and it really talks about how construction has been coming back in the U.S. economy. You might want to look at this because this is a very interesting thing. The last 10 to 15 years, the American construction and housing has just hit a wall, but now it's actually been coming back. So this article highlights it. I also want to mention that during earnings season, we do a recap of some of the big earnings in the United States, and Monex Australia is using the same one here. This girl is basically, she's happy, she's sad. That's what big tech earnings were like. The bad was Alphabet, Google, not good at all. The good was, what was it? It might have been Apple, I think. I can't remember. It was Apple last week. It was Amazon. Those were strong. So we go through all these different companies. If you want to start learning more about U.S. companies, we put a lot of time into reading through these and kind of following them and breaking them down. The key information is in here. So you can look for another one of these. It'll probably be Friday for you guys. I write them every Thursday in the United States. All right, but now we're getting to another area that I think is very interesting that I want to look at, and that is the Russell Small Cap. And I think this is one of the main things we want to look at. This is a very interesting index. It's IWM is the ETF that follows it. Now, this has underperformed for a while. One of the reasons it's underperformed is because so much money has gone back to these big growth stocks, the Apples, the Amazons, the Microsofts. These have been running very well. These are the big growth stocks that have led the market for a long time. But there's something interesting happening when we look at the IWM. So we look at this chart right here. This is the 50-day moving average and the 200-day moving average. There's a technical pattern, and we have some of the we've done some analysis on this here in TradeStation in Chicago, and we actually found that when this moving average crosses through the other moving average, that almost 8 times out of 10 you see significant upside or significant increase in the overall price. This is a certain chart pattern that a lot of people look at least in the United States. It's big on the big indexes and major equities. This is called, sometimes they call it the golden cross. Well, it's just happening now on the small caps. There's also a Bollinger Band squeeze. Now, Bollinger Bands basically show when things tighten up and these two lines, the blue line and the red line, when they move close together, it means that something has stopped moving. But very often something will stop moving, and then when it starts moving again, it can really extend and move. So this shows the distance between those Bollinger Bands. And you can see here that we're at a point now where the Russell is extremely range bound. At the same time, it has this bullish chart pattern. And at the same time, we have something happening with the dollar index. The dollar index, the American, I'm sorry, DX, I'm sorry, I have this other thing on my other, let me jump over very quickly. The dollar index, you know what? There we go. Too many tickers. All right, so the dollar index is basically, mostly the United States dollar against the euro. It's mostly against Europe, but this has been very much trending higher. This shows the strength of the American economy. It shows that, foreign currencies are not doing well. Things like the Australian dollar are not doing great. When you look at what's happening with China and things like that, all of those things are creating a bias toward the US dollar. And generally you see that when the US dollar moves higher, it tends to be good for small caps. So there's a certain correlation between the dollar index and small caps, and this has been moving higher as well. So as people focus on the domestic economy, you're going to see that with the dollar index, and it's something that tends to be a positive for the Russell as well. So I did want to just quickly mention that. If we look over here now, these are some of the ideas that I wanted to talk about today, but the IWM, you can basically see it right here on the Monex Australia platform. And of course, they're right now doing zero commission trading on international equity. So this is another great time to think about, really checking some of these things out. When you look at it, if you're seeing, for example, weakness in, global currencies like the Australian dollar, start to take a look now at what's happening with the American dollar. You start to look at what's happening with the American economy, with the American small caps, because these are very much focused on the domestic economy of the United States. This is something right now that I think is pretty interesting to look at. Now, at the same time, I want to show you, look at this chart. You'll notice the 50-day moving average goes up and the chart pushes above it. It pushes above the green line, the 200-day moving average. Now, I'm going to show you the polar opposite of that. This is the Reuters CRB commodity index, which is basically oil, copper, gold, sugar, wheat. Big commodities are tracked by this index. Look at what this one did. It tried to go up to that 200-day moving average, and it failed. It tried to hold the 50-day moving average, and it failed. You can see right here, there's a trend line coming up, and it broke that trend line. This is the complete opposite of IWM. It breaks to the upside. This breaks to the downside. The Australian dollar, which I'm going to use American futures on the AD, but you can see what the Australian dollar is doing. It looks kind of the opposite of the American dollar. So all these things are pointing in a similar direction, and they're arguing that, now is the time to be thinking that, maybe more along the lines of American domestic equities, less toward the global picture. I think that's one of the things we want to see. Now, another thing I just want to briefly mention is that right now in the United States, we've seen a real sell-off in healthcare stocks. If we look back over here on my Monex watch list, we go to the SPDR, we can see the XLV is, farther away from its 52-week high. You can see in its range, it's weaker here. Now, you may not know this, but I want to just point this out. First of all, healthcare is one of the larger sectors in the United States. It's a huge chunk of our economy. Now, some bad things have been happening recently in the healthcare sector. Essentially, what's happening, if you look at this, is that this sector has not made a new high all year, unlike things like technology. What's really happening is that for a long time, these companies were able to raise prices on the American, public, and they were able to get away with it. And for various reasons, I think some of them political, but also some of them are simply a business cycle where now you have, costs being removed from the system because of different efficiencies and investment. You're basically seeing American healthcare companies are getting squeezed. They can no longer raise prices on people the way they used to. They're also getting squeezed by President Trump and the Democrats. So you have an industry now that doesn't have a lot of friends. It's also an industry that is losing its pricing pressure. And it's also an industry that is not economically sensitive. So when you have a GDP over 3%, when you have massive job growth, when you have rising incomes, when you have a lot of economically sensitive things happening, investors are going to look and they're going to say, why do I want healthcare? It's not going to track the economy. It has political risk. It's a safe haven, but I don't want safety when we have economic growth like this. So I think right now, healthcare is going to be something that at times there are going to be opportunities. But overall, when you look at the way things have been trading now, a lot of people might just kind of think, there's just not a lot of reason to be owning healthcare stocks in 2019. That was good a few years ago, and there's a lot of money trapped in these stocks. So I just want to point that out, that the healthcare sector has traded very heavy. There's been a lot of negativity. And when you dig into it, it's one of those things where there's bad news is starting to get priced in, but is it all priced in? And what's going to happen as we get toward the elections? It's hard to see how it gets better. So I want to just point this out. I don't want to be overly negative toward healthcare. And there probably will be some times when we want to look to that sector. But I want to highlight, this is a major sector. A lot of people look toward it, and a lot of people are trapped in healthcare stocks. And it's an area we need to be careful of. You know, the sentiment has been favoring things much more like, you know, industrials, financials, starting to favor small caps. So let's look at some more of these sort of companies. Another company that is interesting, and let me just jump over now to my watch list, is Snapchat, or it's actually called Snap. Snap, I don't know if you guys have it in Australia. It's like Facebook or something like that. I don't even do social media, but I do know that these companies are interesting. And one of the reasons it's important to realize why is that there are billions of dollars that companies spend on marketing. And we're in a shift right now when that money is going from old television, old newspapers, old radios, and it's looking for new places to go. And one of the most obvious places, if you're a marketing executive, is to dump that into social media. And so I think right now we essentially have Facebook, which is huge. We have Twitter, which is pretty big. And then we have Snapchat, which a lot of people don't even think about. The last 2 quarters at Snap have been pretty good. If we look here at, like, for example, a 6-month chart, we can see this is up almost 100%, you know, since Christmas. But what's interesting about this company is I did a little bit of analysis here. And it's interesting if you look at Snap, excuse me, that they have something called daily average users. Actually, I put this in. It should be DAU, not DUA. I apologize. So daily average users. If you do the math and you look at the market cap, the market capitalization, the value of these companies, and then you divide it by their users, what you find is that at Facebook, you're paying $353 per user as an investor. Twitter, you're going to pay $229 per user. With Snapchat, you're paying $82 per user. So this company has more users than Twitter, and it trades at a huge discount to Twitter. Now, there's a reason for that. It has had business problems. It has not really, you know, it has had a lot of bad quarters, but the last 2 quarters have gotten better. Now, there have been also signs when you look at Snapchat. It has other things coming out, some video game technology. Back on April 4th, they introduced a lot of new sort of products and stuff. And I wanted to just mention that because if we look at Snap, you know, we can see that this is something now that is, you know, essentially just kind of melting higher. It's an area, it's a stock that's under-owned. And the thing is there's really 3 social media companies that you can readily invest in. Facebook has run, Twitter has had good news, and Snap is also starting to move higher. So Snap is another one here that I think people want to be taking a look at. Let's add the moving averages here as well. You can see the 50-day moving average here is a red line on my chart here in the Monex platform. And what you really see is you can see the 50-day moving average is now, you know, coming higher on Snap. It's holding above that. That's an interesting indicator. And I think this is one as well that when people look at, you know, this company, it hasn't had, you know, a whole lot of pullback. Since it started rallying, this is the first real pullback we have near that 50-day moving average, you know, really since it started on this rally. I think this is an interesting stock that is, you know, definitely one that is just starting to get on people's radar screens and starting to get some attention. Now, I mentioned the IWM, and that would be, you know, right here. You know, same sort of thing. You can see if we add the moving averages here, look how tight, and it's holding that 50-day moving average. That is the other thing I think that's interesting about something like IWM. It's just chopping along, making higher highs. But then if you look at the chart, you can also see here's a level, right across here, right around, you know, 158 to 160. This has been resistance on this chart, you know, really going back toward October, and it's just pushing above that resistance. When you look at that tight Bollinger Band squeeze I showed you, all those things right now, the question is, you know, at this point, upside or downside, it's a strong domestic economy. It's an underperforming sector. it has held that 200-day moving average. It's held the 50-day. It's broken the 200-day. It's held the 50-day tight Bollinger Band squeeze. All of those things right now would generally be something that could be favorable for IWM. So I think this is another one we really want to kind of keep our eye on. Another company is a company you probably have not heard of unless you've spent time in the United States. I don't think it's not a global company, but it is a big American insurance company, and that is Progressive. This company has really just absolutely outperformed in the property and casualty space. That's stuff like auto insurance, homeowners insurance. They are growing like a tech stock, even though they are an insurance company. They are growing double digits. I'm not entirely sure why when you really look at it. They seem to be extremely good at marketing. They just consistently are growing their policies, consistently growing their revenue, often beating estimates. And when you look now at the chart, this was an all-time high. It just broke out through like 73, 74. This is the last earnings reported in PGR. Broke out on earnings, and now here it is pulling back, just holding that 50-day moving average. And it's also holding this level right around 73.5, 74. So when you look at Progressive, big rally on April, well, it was right around April 16th or 17th. This was the gap higher on earnings. Now it's pulled back and it's holding this level from before. So these are three stocks that I'm kind of looking at, and to me they're interesting. Like I said, these are interesting because they are domestic. They are, Snap is a technology stock, but it is in many ways, it's a value play, but it's also in an area that's growing. And you know what? It's growing its revenue faster than Twitter. I don't know if it's growing faster than Facebook, but I think it's growing between 35 and 40% annually. I'm talking about Snap. So these are just three companies that kind of jumped out on my radar that looked interesting. Now let me see. I'm not sure if we have any questions. If you do have any questions, this is the first time I've used this webinar platform for a presentation like this. So I just want to make sure if anyone has any questions that I hear from you. I'm not seeing any right now, so I am going to proceed. I just wanted to kind of quickly recap to people the state of the American economy, because I do think it's important to really realize, I'm not just saying this because I'm in America or whatever, but the fact is that if you look at the numbers, the American economy now is doing things we really haven't seen in my lifetime, at least. I mean, the kind of growth we're seeing without people borrowing money, we are seeing economic growth over 3%, and people are not running up credit card bills. They are not borrowing a lot on their mortgages. This is not being fueled by debt, which is very unusual in the post-World War II era. So we see basically in the labor market, it's important to realize that last decade, we saw companies just consistently cutting jobs. Manufacturing jobs they just disappeared if you look at the American economy. And in my view, what happened was we went through a cycle when management teams came in, they found ways to cut costs. That lasted for like a decade. It was a whole process, and now it's going the other way. I know people, just in general, people were working in jobs, and you used to have 3 people, 4 people on your team. Now it's just you. And you're still doing as much work, if not more. That's what it was like living in the United States in this workforce between 2003 and 2015. It was a steady process of job losses. But the thing is that we have seen now the point where you simply cannot fire people anymore. There's all that excess has been cut out. And what we're seeing is there's been a lot of economic data that has actually shown that people at the lowest end of the income scale are now seeing the fastest wage gains. So this is also a sign of a real improvement in the economy. And that's going to be something right now, when you think about it, that's going to trickle through to the housing market. It's going to trickle through to different kinds of consumer spending. The other thing is that we have very low inflation. It's not entirely clear why. I mean, in my view, one of the reasons why we have low inflation is the fact that when you have lower demand for a lot of just general kind of housing goods and things like that, people bought so much stuff. You had square footage of stores growing, people buying all kinds of products, and that stuff has just simply been wiped out. And now you're seeing people are buying things like experiences. They're going on vacation instead of buying a big screen TV. There's been a general shift in spending away from merchandise. And all that sort of thing has trickled through to meaning that things are inexpensive. And I think also when you look at what's been happening with people going online, it's a complicated story, but the old retail model forced you to spend money. You had to go to the store and buy stuff when they told you to for the price they said. Now you go on Amazon, you buy it when you want it. If you don't like their price, you go somewhere else. That's deflationary, and it's been pushing down inflation at the very same time wages are going up. That has been a positive for the American economy because it means that we have Goldilocks. We have a situation where it's not too hot, not too cold. We have steady growth, but we don't have runaway inflation. It allows the Fed to keep interest rates relatively low. It's not always been this good, but right now it is, and we just want to focus on that. And I think it's important also to realize that we are seeing, like I said, a rebound in manufacturing. We are seeing a huge surge in domestic energy production. The United States, I think, now is the biggest oil producer in the world. I mean, it's incredible. We still use most of our oil. We're not exporting it, but we are creating huge amounts of oil. And, that also is trickling through to manufacturing jobs, different kinds of industrial work. All of this is very positive for the domestic economy. And it also means we can grow without debt, which is another thing that is positive because down the road, that will also let interest rates move higher. If you have a lot of debt, then you're like Japan, you have to cut rates. But if you start working through that debt over time, it will result in higher rates. Higher rates means higher dollar, trade gap also narrowing. That's positive for the dollar. So all these things kind of point in that direction of what I've been saying. And the other thing is just that as you look, it's fascinating when you look in the GDP report. There's big numbers between 6 and 9% growth in the quarterly GDP report in software, IT spending. It's really something. So I just wanted to emphasize that. We're going to see opportunities in that area in the future. You want to just read some of the things we publish. We kind of do highlight a lot of that stuff. But that is an area to watch as well. A lot of those stocks have run for the time being, so I don't want to get too much into those. So those are most of the things I really wanted to talk about. My goal here at these webinars is I very much have a top-down approach. I want to understand what's happening in the big picture at the big sectors. When you have the sector right, when you have the big picture right, it makes it a lot easier to kind of make the right choices. It prevents you from going, from making kind of poor choices when you know the big picture story. And, from my point of view right now, when you look at it, the big picture is essentially what I've kind of shared with you. It's domestic strength. It is a lot of strength in technology. However, we have to be careful of semiconductors with this Chinese thing happening. Weakness in global, a spreading weakness in commodities, and an S&P that is essentially chopping at the top of a range, kind of neutral, not bearish, but probably something that could see some chopping down to the bottom. And people looking to add to the broader index might want to be waiting for some of those opportunities. However, something like the Russell right now, this domestic thing, this domestically focused index seems to be in a chart pattern that is pointing much more, in a sort of escaping from a consolidation pattern, with some potential to accelerate. So these are the main things I wanted to kind of share with all you guys. If you have any questions, go ahead and please share them. And don't forget, like I said, with Monex Australia now, you have commission-free trading, 0 commissions on these global equities. And, it's a great time. You can just go here. If you're right here, anywhere on the website, just click on open an account. I think it takes less than 5 minutes to sign up and have access to this platform and access what is really, the biggest market in the world, the most all kinds of stories, all kinds of opportunities that are available in the American equity market.
Thanks so much for that, David. Lots of great insights mentioned and in-depth breakdown of how the sectors are performing in the US. So that concludes this week's webinar. Thanks to all our attendees. We hope you enjoyed it all. You can trade all these securities mentioned and many more on our platform with free brokerage till the end of July. Not only do we do the US, but we also focus on Asian markets as well. And you can get access directly to the Australian market. So if you haven't got an account, you can do it online like David mentioned in the orange button in the top right. It's completely free to get access to all this great research, and the application is all online, takes less than 5 minutes to complete. So if you do have any questions, feel free to call us on 02-9103-9600 or email us at services@monexsecurities.com.au.